You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycle News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
Here we are, a week off of Halloween, and you say the markets are exhibiting strange behavior on what you're describing as a trick-or-treat rally.
Yeah, I've seen some, Jim, I believe, or I want to believe, that the markets are bigger than man, so to speak, in that all the talk about manipulation is, the man behind the curtain, or the man sitting in the little dark room buying the futures contracts and that sort of thing, manipulating the market. I've never really bought into that. But I have to say, when I see data that is, strange, and it can't be explained any other way, something's up. And so I've observed strange behavior this year. That doesn't change anything. I think that the manipulation obviously, history shows that it only makes matters worse, but it is strange nonetheless. And let me explain. The first thing I noticed that was odd, if we go all the way back into February, well, first let me preface this by saying that when the rally out of the 09 low began, I said that it would go up until we got the setup with the DNA markers to cap it. And until this year, we didn't see any cracks. There was nothing in place. But the first little crack appeared coming out of the February low, and we moved into the high in early March, and the market struggled. It looked like it had created a shorter term cycle top, looked like it was trying to roll over, and then right at the last minute, it moved above the previous high, which took out something we call a left translation. It corrected that cycle, if you will. And so it became right translated. And right translated cycles, the signature of a right translated cycle is it makes higher highs and higher lows of the cycle of the same degree. And this may not make sense, but just imagine it as steps. You go up, then the steps are going up, higher highs, higher lows, higher highs, higher lows. Left translation is like steps coming down, lower lows, lower highs, lower lows, lower highs. It's just structure. Well, this cycle, with this weird behavior, it made a higher high and then turned around and made a lower low. And so that was odd, but, you dismiss it. And then from that lower low, the market rallied. It rallied. All of a sudden, it had the signature of a left translation, and it rallied and it struggled into April, May. It couldn't make a higher high, rolled over, started going down with a left translated cycle, and then, boop, it popped up like a beach ball for 2 days, made the high, and then rolled over. Yeah, that was a little odd. And then we get into July, and then, everything was cool into July. Everything was normal. That intermediate degree cycle out of the February low, it became right translated, and then it just kind of, it behaved normal into the July high. Well, as we go into the July high, we had this little Dow theory non-confirmation. And, we go into the August low finally. That cycle low was right on target according to the norms. We were looking, we have timing bands. We know when the lows are going to occur within a 70% timing band, and that one was right on the outer parameters of that low, so it was normal. And then we rally into into the September high, and early September, and the Dow theory non-confirmation was still there. The market was set up. It was set up beautifully. And then, coming out of that mid-September low, I forget the date, but all of a sudden, out of nowhere I assume it was scheduled, but I think it was scheduled at the appropriate time, was the Alibaba IPO. And boop, the market pops up, and it blows out the Dow theory non-confirmation, corrects everything, but it creates the top. And once that top was created, it blew out the Dow theory non-confirmation and everything, but it led to a more ominous setup, if you will, or a setup of a worse degree. Maybe that's a way of saying it. And we declined then into the October, whatever it was, 15th low, and in doing so, we took out, there were some structural issues, we took out the August low, which was a previous secondary low point according to Dow theory, which I feel triggered a Dow theory bearish primary trend change. And also it was a break below a previous intermediate degree low, which means the structure of the market changed. It was a structural shift. It was a left translation. Higher highs. We did make a higher high, but the high failed, and then we move into that pattern of lower lows. And then the rally out of that low began. It should have been a counter trend, the way, when I say should, it's not me trying to tell the market what to do. The market's going to do what the market does. And, but based on the structure, it should have been a failed rally. And right last Thursday, the oscillators finally set up to where it was ready to roll. The industrials were failing or lagging the transports. The transports had made a new high. The Dow theory non-confirmation was in place. I've been watching the Nikkei and some of the other foreign indexes, and the Nikkei was set up to absolutely collapse. We had a quarterly swing high in place. We had seasonal cycle advances that had failed and rolled over. We had an advance, a short-term advance that had ripened the oscillator picture. It was set up, as was the industrials. And this thing was on the edge. On the banana peel with the other foot in the grave, so to speak. And then, out of nowhere, on Wednesday, we had the Fed announcement that they were going to stop doing their thing, and then Thursday night, bam, the Bank of Japan made their announcement. And so, what I'm saying here is that created. It's not excuses, by the way. It is what it is. That did happen. That is how the market was structured, and the Bank of Japan did make their announcement. But what I'm saying here is that I think that the manipulation is going on at other levels besides just printing money and buying bonds and whatever it is they're doing behind the scenes. What is happening, what I'm seeing evidence of now, is that at technical, important junctures, the news is they're orchestrating the news and orchestrating events. They know what they're doing. They're chasing these Dow theory non-confirmations. They're chasing these failed cycles, and it may not be that they're looking at it from a cyclical perspective. Maybe they are. Maybe they're looking at it from a from a Elliott Wave perspective. I don't know. Regardless of how what technical discipline they're looking at it, the end result is the same. At these critical junctures, the news is coming out, things are happening, and I see the unusual behavior is telling me that there is manipulation at these critical junctures, which is something that, I don't recall ever being able to put my finger on. But I think between the Alibaba thing and the Bank of Japan announcement, that is undeniable now. And so you may ask, you say, well, okay, well then what good is the technical analysis? Well, it's extremely valuable because, I think other people I think it's being used and watching it very closely. But here's the interesting thing. Each and every one of these setups has been followed by a more, I don't know how to say it, a worse setup. But yet it's been able to wiggle its way out of it and save it once again. But what I'm saying, I think I see happening here is just like what I said all throughout that 2005, 6, 7 period, is that 4-year cycle advance continued and continued and continued. I said, all this manipulation and things are doing, it's just making matters worse. This is just making matters worse. And I know I've been saying that, but the longer it stretches, it's like the further you get from the revision of the mean, the worse the snapback to the mean. And so it just kicks the can down the road a little bit. And we will know, looking at the cycles in the setup, when the next, or the cycles and the DNA markers and looking for Dow theory non-confirmations or whatever, the evidence is that presents itself for the next setup. We'll know that. And then what I think is going to happen is it's just going to reach the point, it's just going to get so strung out, that, at some point, even this game is not going to work. The next setup, maybe now that we're past the election, maybe they let it go, knowing that it's going to have to happen before the next election rolls around. I mean, my God, you wouldn't want this thing to be going on amidst the campaign season, you know. So I don't know, but it's very, very strange behavior, and history certainly shows that you know, no manipulation over time has ever won out long term. I mean, the market always, the natural ebb and flow of the cycles in the market always prevails. And so, like I said, it's only making matters worse, but it's what I'm seeing is you know, strange behavior, which I think is manipulation based on the technicals.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. My guest is Tim Cyclesman Wood, editor of Cycle News and Views on Cyclesman.com. Tim, the European Central Bank has said if the Japanese quantitative easing doesn't work out and do the trick that we've been talking about, they're prepared to do more stimulus. How can they do more stimulus when they already have minus interest rates?
You know, I don't know. I guess the stimulus is they absolutely start buying the market, and the Feds around, you know, the central banks around the world become the market. I don't know. I don't know how they can continue doing this, but like I said, I just, you know, I don't know. There's no way though. There's no way you can negate these natural forces, these natural cycles within the market forever. I mean, what they're trying to do, there's an ebb and flow. I mean, since 1896, and I'm sure there's other people have other history to show the same cycle within maybe some other stock market type averages or stock behavior prior to that. But in the U.S., the Dow Jones Industrial Average came to be in 1896, and since then there has been a 4-year cycle, ebb and flow. It's averaged 48 months from low to low. This is month 68, and you cannot negate the business cycle. There has to be an up and a down. It's just like inhaling. You know, it's nice to get a breath of air, but once it's used up, you need to blow it out and get another one. And so they're toying with Mother Nature, and yes, they can do it until they can't do it anymore, and then it's going to end very, very badly because statistically, historically, it's just a fact that as long as there's been markets, I mean, even in the 20s, they tried to manipulate the markets. I mean, you had the Hunt brothers trying to manipulate silver back in the 80s. There is not a single case of manipulation that has ever worked, ever. It's a statistical fact, ever. And so this time is no different. So do they string this thing out for another week, another month, another 6 months, 2 more years? I don't know. When we see the setup again, then, you know, we will know that we're at a window of opportunity, and if either it sticks or it doesn't. And that's what we're watching in the reporting on in the short-term updates and stuff. But you know, to think that this is some new era where, you know, the central banks are just going to control the world and negate the business cycle, no. Not going to work that way. And I'll show you evidence of that, by the way. The deflationary forces are wreaking havoc on the commodities market. I haven't looked in a while, but the last time I looked, and don't hold me to this literally, because I looked at a bunch of charts and I don't remember exactly which ones I was looking at, but looking at corn, and I looked at soybeans, I looked at wheat, some of the commodities, and they were back to the 09 levels, or right at it. And if you look at crude oil, obviously it's not back to the 09 levels, but look how crude oil has been hit. Look what's going on with gold and silver. Do you know why that's happening? It's real simple. There is a cycle in commodities, and I reported on it in my letter back in August, and I said that there's a 3-year cycle in the CRB index, and I said, you know, we had the setup, and pretty much confirmed that it was set up just like the deflationary cycle in 2008 with commodities. DNA markers, 100% of the time, this has happened. Here's been the result. Well, we set up just like that again with this 3-year cycle in the CRB, and the deflationary forces are being, they're showing themselves. So these cycles work. The statistics work. They're statistics, and they work. They're going to have their way. And so what I'm saying is the deflationary forces that we're seeing in commodities, it's bearing down on everything. It's bearing down. We're seeing it in even if you look at some of the housing indexes. Look at what gold is going on with gold. Look at everything except equities. Equities is the holdout, and that's where the concentration is, because that's where people look. Everybody thinks, well, okay, gold's down or oil is down, which I think is a good thing with oil being down, but everybody's focused on the Dow Jones Industrial Average or the S&P, and so that's where they're focusing to try to keep things together for the illusion that everything is okay. And what I'm saying is these deflationary forces are going to have their way. It will happen. And so we have to wait and see when the next setup comes, and then that's the window of opportunity.
Tim, how do you feel about the people in Japan about to retire and collect their pensions, because their stimulus program took the money in their pension fund, the biggest in the world, and has gambled it on the equity markets? How do you feel about those poor folks?
I don't like it, and I don't like the fact that what's going on with interest rates. I think that's wrong, to where people, they try to, that's part of the manipulation. When you say manipulation, that's broad-based. It's broad-based in the sense that, okay, you create an environment where if a person wants a return, they have to go to the stock market. And I think that's basically what you're saying. If you want a return, you can't go to bonds and get 6% anymore. And I think that, the manipulation is at many fronts. It's not just one. It's not just the central banks. It's the environment they try to create. Yes, I think that there is technical things going on. I don't know what's going on behind the scenes. That's way beyond my pay grade, but I do know this. I know when I see unusual cyclical behavior that it's unusual. It's not natural. I mean, you don't have right translated cycles go below previous lows and left translated cycles go above previous highs. Doesn't happen, but it has. And so that tells me that there's something unusual, very unnatural happening. And, I think that's, again, part of the manipulation. It's widespread on many fronts. I want to add one thing here for people to think about. I know that with the market setting at a new high, that this may be a very, very hard concept to grasp. But based on the statistics, based on the fact that this is the longest 4-year cycle advance in history, we're now in month 68, and the longest 4-year cycle advance ever. Well, let me back up. Let me preface this statement so that people fully understand what I'm trying to say. Since 1896, there's been a 4-year cycle. From low to low, you measure cycles from low to low. From low to low, the cycle has averaged 48 months. And I developed the DNA markers to identify the lows and the highs so that in cases like this, you couldn't look at a low in, say, 2011 or 2012 and say, well, and I've heard this argument say, well, that was the low. We had a short low there, so this cycle really isn't stretched. We're really not that far down the path with this one because the low really occurred back there. No, that's wrong, because I have a checklist of things that have occurred at every 4-year cycle, top and bottom, since 1896, including the 2007 top and bottom, the 2007 top and the 2009 low, and nothing was in place in 2011 or 2012. So I know we're dealing with a stretch cycle. All right, so you have a cycle that averages 48 months from low to low, and you have the longest extension ever for one of those cycles being 60 months, which led us into the 87 top. That was the first 60-month extension, 87, and we see how that one ended. And then you have the top into 2007, which tied the 87 top, 60 months. All right, well, now we're in month 68. So we've surpassed even, those crazy extensions of those cycles. But then if you look at the 4-year cycle another way, and you look at the longest 4-year cycle ever from low to low, well, they managed to stretch the one out from 2002, which was where the 4-year cycle low was, to 2009. I think it was 77 months. Crazy extension of the norm. But it was 77 months. We're now in month 68. So if you work within the parameters of the norms, we're so far outside of the norm from low to high, and from low to low, that, if this cycle were to correct within those parameters, then within 8-9 months, we should see the 4-year cycle, a 4-year cycle low. But then add to that this has been a manipulated rally that I believe without question has occurred within the context of a secular bear market. And the statistics according to that tells me that, the decline into the 4-year cycle low should go below the previous 4-year cycle low. I know that sounds crazy. I'm just telling you what the statistics says. But then look at the facts surrounding that. I've been saying that the secular bull market topped in 2000. Well, the behavior not only of the volume characteristics and some other things that define technically a secular bear market, but the behavior of the cycles themselves tell me with the move below the previous 4-year cycle low, 2002 low went below the 98 low. That's a signature of a secular bear market. The 2007 low went below the 2002 low, the 2009 low went below the 2002 low. That's a signature of a secular bear market. And so all the evidence suggests that this is a secular bear market, and the statistics suggest that we're going below the 2009 low. And so what I'm trying to say, if I tie this all up in a bow, you have that, which says, again, that this has all happened within a secular bear market, and that we should go below the 2009 low, and you're dealing with the longest extension from low to high ever, and you're dealing with at least the second longest extension from low to low ever. And so there's only one way I know to look at that, and that is that this makes for the riskiest stock market environment ever. And we're sitting at a new high. The little games behind the scenes continue to take place. Nobody sees what's going on. Nobody understands what's going on. And it's a disaster waiting to happen. I have my concerns. I know it's hard for people to see this. I know it's hard to understand, but when you look at it through the right eyes with the statistics, it's extremely dangerous. And like I said, it's the setup. They come and they go, but now the election is behind us. We need to see what the next setup brings.
Tim, thanks a lot for being our guest.
Jim, you're very welcome.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.